What I'm going to be doing in these videos is applying the Wyckoff method in a very practical way. When I first studied the Wyckoff method, it seemed it was difficult to bridge the gap between the academic to the practical way and how to trade. So I'm going to be bridging that gap, and also just this really is for me to analyze intraday trends and a number of other trends, and more importantly, like keep a position sheet where I go over these markets and am able to identify key points in the market where you have high probability trades and you can catch markup or markdown. Every directional trader wants to get markup or markdown. So I'll be applying the Wyckoff method along with trying to keep a position sheet. That's what I'm trying to do. The Wyckoff method would be applied to basically intraday charts on the futures markets, as well as charts that are they're not really swing trading, but I guess you could just call it just longer term charts, but not too long. Okay, alright, so besides that, the tools to use are Weiss wave and basically average true range. The bottom indicator is nothing more than average true range and identifies big average true range. That's very useful at key points. You don't just look at red and green. It's red and green at certain key points. That's what matters. And besides that, just taking a look at these trends intraday, and I'm going to start off with the crude oil. What you notice here is obviously there's a downtrend, right? And over here what you have is 115 volume, but what's important is not the 115 volume, but what comes after it. You have two tests that are slightly lower than the 115. The fact that they're slightly lower and has shown no volume means supply dried up. So you have 115 down, after multiple waves, and then a secondary test on 23 and 24. When it goes from 115 to 23, 24, when the volume dissipates like that, that means that you have secondary tests that show what? A lack of supply. Alright, so you have the lack of supply here and here. Now the trend hasn't turned yet. Okay, the trend hasn't turned yet. Lack of supply will allow buyers to come in, will allow traders to do this. The 196 up right here is the sign of strength, which we will be calling the change of behavior, or just high volume, or just demand. Whatever you want to call it, the point is the lack of supply caused the increase in demand. And how you know that this is legit is for multiple reasons. First, the fact that there's lack of supply, then demand came in, is very important. Typically, demand will come in when there is a lack of supply. And if there's a lack of demand, supply will come in. So the other thing to note is that, ideally you want to keep this is the minor creek here. So, I want to try to get in around here, but unfortunately it doesn't go that low. So it doesn't go to minor creek, but it goes to the creek area, alright, which is here. So this jump over the creek, pull back to creek, which is another term, jump over the creek and all that, but that's not what we were interested in. We're just interested in looking at it from supply and demand perspective. So, you could call this demand or anything else, a lot of different terms. But when this happens, it took out these highs. That's really, really important. The fact that it took out these highs means it jumped over the creek. All right, it's not an inside wave, it's a breakout. All right, and there is cause in the background. This here qualifies as cause. Okay, so once it does that, it's a 1, 2, 3 correction, and then what you have is the thrust, which is basically telling you the market's going to enter markup. Now, granted, there isn't that much markup, because there isn't a lot of cause, but the market really just goes up to this point over here, and markup, creek, test of creek. By the way, it's really important to note that within this is high volume right here, as well as these green, 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 but basically saying that these are big thrusts. That's a lot of bullishness. That's how you know that this move here is legit. And then it really isn't a matter of market going up or down. The probability favors up. The only thing that matters is how do you get in. Getting in on the retest. That's what the real skill here is. So after the COB 1, 2, 3 pullback, entered markup up to a point. Where you have high volume. So the trend is, you got T1, which is a downtrend. You have T2, which is an uptrend. And then T3 is about to start. Now, what needs to be looked at is initially the high volume going down. 153. Obviously, it's not 153, it's 153 in hundreds. So it's like 15,300 on this down wave. This down wave only qualifies as a sign of weakness when there's an LPSY. LPSY is characterized by low volume. So all it is, it's low volume demand and a break. So you have here 153, and then finally you get your lack of demand. But what's even more important than that is this. Is this effort reward. That is the point. That is the point that you should, in my opinion, get ready to short. Now, how do you know it's effort reward? Is because the 78 is unable to take out the 27. 78 up volume, unable to get up above 27. 3 green bars, unable to get up above 27. So typically what happens is you get your LPSY, and then usually there's an attempt to go higher. There's your effort fails, and what happens after that is you get a thrust with a low end close. You get that thrust, and this is when the thrust and the red bars are, this is when this indicator over here, just the true range, is important. Because at this point, the short can be established. Now, where can you establish it? On the low, in the middle of the thrust, it's up to you. For me, it's just, it's anywhere within the thrust. More importantly, where's the stop? The stop goes above low volume. Above here. Okay, because that's where effort couldn't get above. So that means that that's the ideal place to put the stop, just above low volume. And the trigger here is the thrust. Okay, once that happens, you enter markdown phase. Okay, enter markdown. Intraday markdown. By the way, there's 116 over here, and I don't think that's trivial. Now, we want to see the 6. I don't know when the testing is going to happen, later on today or tomorrow, but that's really, really important, because I think they're going to try to test the breakdown. Anyway, so the point here is there's a trend up here. This T2 is an uptrend. How did it start? Change of behavior, pull back to test the creek, enters markup. Then you have sideways distribution. Very rarely is it so obvious. Very, very rarely. Usually it's not that obvious. Anyway, so it goes down on 153, then another 153. This is what I mean by obvious. Big selling wave, big selling wave. Okay. Yeah, 153, 153. And then see, at this point, you want to get short. No, you don't want to get short, but you're bearish. Okay, you have to wait for a trigger to get short. So over here, this is very bearish. In fact, together it's over 300 volume on the downswings, on the down waves, which is greater than the sinus strength of 196. That's telling you that that this is valid, but you don't really know, because, well, what they try, this is a little bit confusing when the 127 comes up. So at this point, you're like, this looks bearish, but what about this 127? Is this reaccumulation? So there's no trigger yet, and it's like you're on a scale. Is it tipping bullish? Is it tipping bearish? The bears have the case of 153, 153, 300 plus downswing volume greater than the change of behavior. The bulls have 127 over here, and all that matters now is how the right hand side develops. Okay, the key was the 27 followed by the 78, which basically told you that it's really bearish, not bullish, and that 127 is some type of hypodermic maneuver, or it's an effort, or it's some type of failure. Okay, that is only known when you get on the right hand side and you have the 78 to 27, this effort. And then when you have this thrust here, that's the trigger. How do you want to get in? Low of the thrust, middle of the thrust, it's up to you. But the stop needs to go above the 27, because that's where the market couldn't get above on 78 volume. It failed. So, and then this is the markdown piece of the trend. This is intraday trend analysis, where you have, basically uptrend, distribution, downtrend. It is very important to understand these phases and how they occur. And here's where I bring in my fancy notepad. 1 second. Not notepad, paint, yeah. Many of you have already seen this chart, this simple graphic, right? This is what they call accumulation. This is markup. This is distribution. And this is markdown. Practically, this is how you need, in my opinion, this is how the market needs to be viewed. Accumulation, markup, distribution, markdown. This is a very old figure, very old chart, that was depicted in many technical analysis books. But the question is, how do you identify markup? And how do you identify markdown? Well, typically it's through a sinus strength and a LPS. Okay? This is just fancy words for high volume plus low volume. High volume demand plus low volume supply. High volume demand later on became sign of strength, and low volume supply became LPS. And obviously there needs to be a breakout or follow through, and then you get in on the test. And the same thing over here occurs over here, where you have high volume supply and low volume demand and a break, and then you enter. That's what sets up the trends. Case in point, high volume supply, low volume demand, effort, crack, right here, enter. Okay. Again, high volume coming in. We'll see the tests, follow through, enter. That's how you know one side is in control, when it proves itself. The market needs to prove itself, with one side being strong and the other side being weak, and follow through. In any case, this is the type of Wyckoff trend analysis that I'll be doing for markets intraday, as well as some other markets that are a little higher time frame. And then what I want to do is manage a position sheet. As you know, it's not easy to manage a position sheet. It could be very labor intensive, but I figured out a very, very simple and easy way to do it, which is literally one column in a notepad. And if it's that easy, I think that people do it. I'll do it. But if it's something that's taking hours every day, it becomes, because you're tracking, let's say, 100 markets, it's difficult. So we'll be taking a look at a few markets, very likely the futures markets, like gold or crude, and some other markets as well, and just keeping their technical position. Hope you liked what you're about to see. The other thing is, I'm doing this because a lot of the stuff that I found online, there was an inability to bridge the Wyckoff method from a more paper approach to an actual practical trading method, and that I believe that is something that I want to explain. So sometimes the 500-page or 1,000-page course or whatever, sometimes a little bit too much, and and then using the right tools. Again, this is the Weiss wave. You just use a zigzag indicator with volume, or swing indicator with volume. Same thing. Bottom here is the true range, and that's it. Thank you.